Great day. Thank you again for tuning in. You are tuning into Currency Market Execution, the channel with a difference, where you get everything to do with Forex, everything to do with market trading, where you get to improve your trading. If you did not yet subscribe to this channel, this is an opportunity to do so. Otherwise, my name is Mokhomutsi. I also go by the name Proqnosiz. I also go by the name Alpha Wolf Forex. Otherwise, I welcome you again on this wonderful chart pattern series that we are doing. We've been busy with the chart pattern series. This is video number 4. If you have missed the series, there's other videos you can check down on the description and get to watch all the other previous videos. Otherwise, let us go right into it without wasting any more time. Let's go.
Ride around music loud, swerving with the top down, living life on the right. You only get this once, catch me riding around.
Let's get right into it. Otherwise, I'm still your boy Proqnosiz, aka Alpha Wolf Forex, aka Mokhomutsi. You are still tuned into Currency Market Execution, leaders in Forex trading and education. We are covering chart patterns, or secrets to chart patterns, or decoding the secret codes to Forex chart patterns. As you all know, that chart patterns, they apply in different types of currency market, whether it is your stocks, whether it is your indices, whether it is your CFDs. Chart patterns will always be there. We have covered previously reversal patterns on the previous videos, and then right now we are still busy with continuation patterns. And then after we deal and decode the entire continuation pattern category, we are going to look at bilateral patterns. So let us go. What have we covered so far? So we established that in continuation pattern categories, we have continuation wedges, which we covered in the previous videos, cup and handle, which we covered in the previous videos, and the bullish and rectangle, and also flex. I put them together. You will know why in this video. This is what we're going to be doing today, and then after this we're going to look at bullish and bearish pennants. Now let us go. So what is a rectangle? A rectangle is a continuation pattern that forms as a trading range during a pause in the trend. The highs and the lows can be connected to form two parallel lines that make up the top and bottom of a rectangle. Rectangles are sometimes referred to as trading ranges or consolidation zones or congestion areas. As we all know, that the market moves in three different ways, which is the uptrend, the downtrend, or consolidation, or the ranging movement. So this is what we're going to be looking at now, where this is where you are going to find your rectangles. This is how a rectangle looks like. This one is a rectangle in a downtrend, and then you find it here. There you see your resistance, and your support is when the market is moving sideways with no clear direction. So continuation pattern rectangles. So rectangles can be successfully traded by buying at support and selling at resistance, which is your range trading, or by waiting for a breakout from the formation, which is basically your pattern trading, where you actually trade the breakout of a pattern. Most technical traders agree the rectangle can serve as either a reversal or continuation formation. I believe you do agree also. As a reversal pattern, it ends a trend either up or down, and as a continuation pattern, it signifies a pause in the prevailing trend with the expectation that the prior trend will eventually resume. So in either case, the rectangle shows a tug of war between buyers and sellers, or you can basically say the indecision in the market. So I want you to remember this point as you continue to break down the rectangle. A rectangle occurs when the price is moving between horizontal support and resistance levels. The pattern indicates there is no trend, meaning there is no up or down movement. It is just a sideways trend. As the price moves up and down between support and resistance, the price is stuck in a range. The rectangle ends when there is a breakout and the price moves out of the rectangle. The bounded range of a rectangle generally occurs when investors are indecisive, or traders are indecisive about the long-term direction of an instrument. So it rises and falls within the defined range, unable to make headway either way. So how does one trade the rectangle? We have already established that a rectangle can be traded in both ways, which is range trading and breakout trading. Range trading, that is trending within the pattern within the rectangle, and breakout trading is actually trading the breakout of the pattern. So you can trade it in both ways. We're gonna look at now trading the rectangle using range trading. So range trading is basically trading support and resistance. Support is defined as any price below the current market price, and I know you know what support is, but I just want to cover it. So where buying should emerge to create, at least temporarily, a pause in a downtrend. Resistance, on the other hand, is any price above the current market price, where selling should emerge to create at least temporary or a pause in an uptrend. Here I'm just putting it based on the rectangle that we covered. In a rectangle, what may be referred to as significant support or resistance emerges, that is a price level returned to again and again. That is in a rectangle. Basically, also if you still maybe don't have any full-on understanding of support and resistance, please do check out our website. We do cover it in detail in our various courses that we do have there, or you can just go through down my channel, and I'm sure there is a video which covers it in detail. So let's look at range trading. This is range trading in a channel. Basically, range trading, you are basically trading a channel, or you are trading a rectangle. That's what it basically is. So how do you do it? Rectangles appear on any time frame. As such, range trading can successfully be performed on all time frames, because no matter what time frame you use, you will find rectangles. They appear on all different types of time frames. There are various ways to perform range trading or trade rectangles, which can include use of stochastic and RSI indicators. I cover that in depth in our online courses available in our website, as I just mentioned right now. So right now I'm just going to show it to you using via price range. Otherwise, let me just show you a bit what I'm talking about. You see here, this is your stochastic and your RSI indicators combined. If you don't know how they work, do check out our website. We do have online courses there where I teach you how to use different types of indicators and how to benefit and make profit from it. But this another way to trade. There's another strategy you can use to trade the range using a stochastic and an RSI. And I'm just going to take you through the normal price action one, where you get to break it down and understand what is actually going on. So this is the same chart that I just showed you, but now this chart right here is a Euro GBP. It's a 4-hour chart where we now do not have the indicators on the screen. Basically what's happening here, you can see the market was trading downward. It got stuck here in a range where it created a resistance zone and a support region. Understand that these are not lines. That's why I made a box a bit thick. I basically did it like this to actually show you that this is not just a line. I know most people, they'll draw a support or resistance just making a thin line and believe that's where the market will reverse. Understand the support or a resistance, it is a zone, so it's not one region, it is a zone. So this zone here is your support and this zone here is your resistance, and it can even extend and the market can close and come down again. Otherwise, this is what happened. This is your rectangle. So the market was trading bearish, and then it hit this level here, which is your now support, and then it pushed the market up and it could not break the previous support. This is the previous support, it couldn't break it. Now this becomes now your resistance. This is what happens. The market goes down, and you see here what happens. It did not fully come to this because it is a zone, but we'll cover this and I'll explain why this happens also in the rectangles, and yeah, as we continue with the lesson. So watch till the end of this lesson for you to get the full benefit of this course that you are busy doing. So you see, after it established a resistance zone it further went down to test the support zone. And what happened? This is now your area of interest. This is now your area of interest because you already know that this is your support zone. So every time the market, as it happened here, the market reaches this zone, it's going to push up again. So this becomes now your area of interest, that you know once the market hits this price, the market will most likely push to the upside. And then now you look at this zone here, because what happened, though this is your area of resistance, you do understand and do see here again, this is a mini resistance zone or a mini support zone, because it did push the market up here. So this becomes a mini. If you go down a time frame, you'll get to see this extended because you're on 4 hours. So if you go down on a 30 minutes or 1 hour chart, you'll get to see that this is now extended and it becomes another zone. So the best possible option for you to enter is to enter around or just after this zone is broken. But you are right now trying to look for an entry. You already know that this zone right here will bounce the market off, but you already know that here is a mini resistance zone. So in a range, try to also look in a range and look for other mini support or mini resistance zone within a range. They will help you when it comes to trying to find your entry and your exit. And then you just know that automatically just above the main resistance, it will be your stop loss. So it came here, it hit your area of interest, and then the market pushed up. So where should your take profit be? Okay, this is now covering your entry. I know that this is a previous support, which now becomes resistance. So whenever the market reaches this zone here, it is most likely to reverse again. So my take profit will be around this zone. Why? Because of I know that this zone is also now a zone of interest. So it makes things easy for me to trade. You saw here the market came down, hit this zone, and then it bounced up again. So which means I already took 2 trades that gave me profit. But you must watch this now. If I am going to be buying, then my stop loss will also be in the same zone where my previous. When I say same zone, I'm saying behind or just above the support or the main resistance. So because I am sure that this will always reverse the market. Now the point of interest that I want you to see, okay fine, is that I will cover as I'm going, that when you are doing range trading in a pattern, you get more opportunities to trade than if you're going to do breakout trading. That is why I actually prefer to do the range trading in a rectangle than just wait for a breakout, because you're just waiting for one opportunity which might not even materialize. I will cover that as we continue. So there is something that I want to show you here, that even in a range you have those points or sometimes where if you are going to do a lot of tradings like this where the market will not reach the zone, that's where now your stochastic or your resistance comes, or your understanding of candle patterns formation. As we see here that there's an inverse hammer, that it will most likely show you that the market will reverse. Then you can automatically put a trail stop, automatically put a stop loss after this candle forms, just so that you can at least leave with some profit. But if you don't do that, or you just want to fully materialize and wait for the market, this will eventually be a loss. But it is not a problem, because the probabilities of you trading a range successfully, they are too high. So even if you going to have one loss, you might have 4 or 5 wins in that, because you'll be able to take, sell and buy orders within that range if you're just going to be following what I just said right now. So that's what I wanted to show you, that sometimes, let's say you took a buy here, it did not activate your take profit, but also even though it did not activate even though it did not activate your take profit, it still never activated your stop loss. So the only negative here is with stuff like this, you might also miss a sell opportunity here. That's just what I wanted to show you with the zone, because you might not realize your take profit, and then you will also a possibility of missing this opportunity. So that's what happens. So that's why sometimes you must always look at the candles. You must always try to do your trail stops or lock your profits when you are gauging and checking out the candles. The next series that you're going to cover, will be going deep in candle patterns and candle shapes for you to understand more, because when you're going to be doing price action, like even trading within the range or doing range trading, it is very important for you to understand the price action, because though it looks easy, it is easy because you understand and we are using price action. Look here, you can see here this candle shows you that the market is going to reverse. So it's not only support and resistance, you also look at what the candles are telling you. You can see here, let's say you missed this opportunity, or maybe you incurred a loss, you wait for the zone, you check the market is trading below your zone of interest. As it gets in your zone of interest, you place your buy and you go straight and hit your take profit. So you'll be able to make that loss you'll be able to make up for that loss that you incurred, or make up for that missed opportunity that you missed on the zone here. And then what happens, same, it goes up again, you wait for the next candle, it takes, you look point of interest, this candle here, you go for your sell. So that's what happens. This is how you basically would trade the range. It's actually simple, but I said it is simple because you'll be understanding price action. So we've looked at trading the rectangle and trading the range, because we have already established that a rectangle can be traded in both ways, which is range trading and breakout trading. So let's look at breakout trading. When the price breaks through support or resistance, depending on the bias of the previous main trend, the buy if the price moves above resistance, or the short if the price falls below support is applicable. Stop loss is placed in case the price reverses. These tactics sound simple, but they are not so simple to implement in the real world. Usually the price won't stall at the exact same support or resistance each time the price visits that area. That is for breakout trading. Determine where to go long or short, or when a breakout occurs and it is not always clear. I'm going to show you on the next slide what I'm talking about. So this is basically how it looks for your breakout trading. The price movement or the uptrend gets stuck in a trend, it gets stuck in a rectangle. That's where we've been doing our range trading. And then once you are a breakout trader, or you are trading the breakout of a rectangle, it means you'll just be trading one opportunity. That's what I was talking about. Like here you would have 1, 2, 3, 4, 5 opportunities, 6 opportunities for you to take. But for breakout trading, you are only waiting for one opportunity, which might also not materialize. I will explain further. So breakout trading, a rectangle is easy to spot but not so easy to trade. The price won't always reach the prior support or resistance levels, and sometimes it will exceed them. That's what we covered on the previous slide, where I showed you that sometimes it will not get there. But what can you do? You can put your stops, you can put your trail stop, you can put measures or check your candles to make sure that you are gauging the market. You are checking how the market is moving so that it does not reverse on you. So that can trick traders, resulting in missed or losing trades. So false breakouts are plentiful during rectangle. This is now for breakout trading. So some breakouts will result in huge profits as the price explodes out of the rectangle with a big move. Many rectangles will end with minimal price movement. In some cases, the price moves out of the range and then starts ranging again. I'm not really bashing breakout trading. I am just explaining it and basing it upon my experience on the charts. Though breakout trading can give you a lot of profit, but breakout trading market makers, they benefit a lot from it. What do I mean? Look, this is the same chart that we looked at. This is the continuation of the same chart that we've been trading on, like around this zone. That's what we've been doing, the Euro GBP 4-hour period. There was here, look here what happened. The market broke out here. So this gave you a sign of a breakout. maybe you had your entry somewhere around here, it will reverse, gives you a spike, most likely stop you out. But if maybe you wanted to enter late, still here, it will still push you out. Market maker or the market usually does this, depending also on what broker that you are using, by trapping traders with false breakout. You know, it's very easy to trap a false breakout trader. So look here, the market went down. This was, look here, the market gave you this hammer candle. It shows you that the market can still go, but then maybe you say, okay, fine, I'm not gonna enter. You wait for this candle, which is a full on candle. It opened inside the support zone and close fully below, so it gives you the impression that the market's gonna go down. You enter on the next candle and it pulls you up. That's what happens normally when you do breakout trading. So you must always be aware of the risk. So the market came here and then it pushed back inside again the rectangle, and then what happened? The market traded in a range again. You know, the market traded in a range again. So you find here is a range, so you are basically going to be looking for things like this and trade a breakout of a range that happened. It doesn't happen like this all the time. Sometimes it will just go out and you'll have a powerful move like we explained in the previous slide. Sometimes it will give you a false breakout and then it will trade again in a mini range. Then you have to wait and look for the breakout of that range like what we did here, and then you can get your most likely your 1-to-1 just above 1-to-1. There's many people who would say how to trade the range. There's some people who say your stop loss, you put it above here. Some people say you put your stop loss above here. It just depends on your risk. For those who believe you put your stop loss above the zone here, is those ones where they will say that they measure the length of before the market went into the range, and then you going to do 1-to-2 or 1-to-1 of that one. It simply depends on your risk appetite, you know. But if you don't want to risk a lot, this what you can do, because it's, you know, you can put here and then it will be pointless for you to go for a risk reward ratio of 2-to-1. You know, you should always go for 1-to-2 upwards. If not 1-to-1, it is okay, because most patterns, especially for pattern trading, it will give you 1-to-1 or 1-to-2. 1-to-3, they don't happen quite often. So that's what I am talking about. So you see the market then pushed down and then it went out to give you a breakout. So what is bullish or bearish flex? I did tell you that to me, rectangles and flex are the same thing. This is what I mean. It just, for me, they are the same. You know, you might trade it differently, but they are, for me, they are the same. So typically appears as a minor consolidation between impulsive legs of a trend, a rectangle. When this pattern forms on the chart, there is a high likelihood that the price action will break out in the direction of the prevailing trend, that is in a continuation pattern, as we are talking about continuation patterns right now. So it is basically a range or consolidation which appears in sloping manner, unlike a rectangle which is horizontal, sorry for that spelling, in shape. So that's what it is. So how does a bearish flag looks like? It looks like a rectangle. You know, it's just a rectangle with just a slopey feature. So there you'd have your pole and there you'd have your flag. That's how it is. So there's your bullish flag, then there's your flag pole, and then your flag. But it is, you can just see that it's exactly the same like a rectangle. Exactly the same. You can do here range trading, or you can do breakout trading. What the only other feature that people would say, they will look at the flagpole and then they would measure this as their target. You know, they would say once it breaks out here, then you would measure this as your target. Some would put a stop loss here at the bottom, and then they would aim for the length of this pole here, same way to the side, same way to the side. So that's what usually would happen. And you know, so like I said, it's just up to you. But to me, when I look at it, it is exactly the same as a rectangle, and I would trade it the same as a rectangle. So you would have only one opportunity that you're waiting for, or you can just take in and trade within the range where you will have more opportunities as opposed to only one opportunity. So let us just do a recap on what we just covered. As you can see here, this is your bullish rectangles and your bearish rectangles. You can see that they look the same. As you can say, this is your bullish flag, and this can be your bearish flag. They look the same. That is why I'm saying it's the same thing, same trading. So I'm not going to go in and just go in deep again about flags, and just remember we trade them the same. You know, we trade them exactly the same. So rectangles and flags are built on the same principle, thus can be traded the same. So breakout trading on flags and rectangles can be tricky and produces less opportunities or trading periods. As you see, 1 2 3. Okay, let's say this won't obviously trade. So 1 2 3 4 5 6 opportunities, as opposed to here you'll just be waiting for one. So that's what I mean. So range trading between two bounds or lines gives no guarantee that an order will be filled exactly at the bound. What we covered, where I showed you that sometimes even in range trading, sometimes this can come back here, hit this point and touch here, and sometimes it will not touch it. Just like when you're trading or you're doing your swing trading, you understand that sometimes it will not touch the trend line. That's basically what I am saying there. So last but not least, the rectangle formation needs to be high enough from support to resistance so that traders can achieve results, allowing them to absorb the above mentioned cost and price filters. What do I mean? You always want to, like I said, ranges and rectangles basically, they appear on all time frames, but you don't want to trade something which has, like for example, 300 points maximum range, or like 200 points maximum range. You know, like it is a bit risky for you when you are looking at risk reward ratio and your stop loss, how you will place it depending also on what pair it is. You know, for example, trading Nasdaq range, like, you know, with 300 points, that's like suicide, you know. So always look for ranges that are a bit wider. It gives you room to gain some points. It also gives you room to play around with the trade. Okay, and it brings us to the end of our wonderful session that we did. We're going to be looking at the bullish and bearish. We're going to be looking at the bullish and the bearish pennant on our next video, which will be the last of our continuation pattern, and then we're going to be covering our bilateral patterns. We're going to be covering our bilateral patterns, and that brings us to the end of our session today. Do not forget to visit our website www.currencymarketexecution, just there, right there above me, and then do please subscribe to our channel if you like this type of stuff. There is many other videos which we cover different types of stuff. Every Tuesday we do our educational video, every Thursday we do our psychological trading video or emotional intelligence, and then on Sundays or Mondays we do pre-market analysis or just analysis. And we do have a lot of stuff that we do with the teams where we do analysis together, where we look at the market, where we go in depth and look at all different types of strategies, and we also do signals, or what you can say, copy trading. So do check us out and check what type of offers that we have there. And then we also have a Telegram channel where we do free signals, where we do free courses, where we do everything for free. You don't pay anything to join our public Telegram channel. Do please also visit our social media links, which is Currency Market Execution for Instagram and Currency Market Execution for Facebook, or our Telegram public channel. Do please subscribe if you did not subscribe to this channel, so that you can get a notification whenever we do or post another video, because we always post important, informative and golden videos that you always gain and benefit something from. So my name is Mohomuti. I go also by the name Proqnosiz, or you can also call me Alpha Wolf Forex. Don't forget to check out the description for offers, for giveaways, and as we sometimes just hide it there for you to find as our little treasure hunt. Otherwise, it was always fun being with you. Meet me again on the next video, or what you can simply do is watch these videos that are appearing now. Believe me, you need them.